Hey everybody, it's Daniel here from Infovest. Hope you're all doing well. So we got some very interesting jobs numbers that came out from the US, and basically the numbers came in a little bit below the expectations. If you look at the US non-farm payrolls report, the headline number, basically the jobs that were reported was 150,000 versus the expected of 180,000. So a little bit lower than the expectation. This comes down from reporting jobs number last month about 297,000, right? So this is basically a number that gauges and tracks from the government. They're tracking how jobs in America are panning out. Are you seeing an increase of them? Are you seeing a decrease of them? And if you look at since March of last year and you look at the chart, you see a chart where there's, yes, spikes, but overall trend is it's coming down. So you're seeing that jobs are getting weaker and weaker and weaker. Same thing with the Canadian employment report as well, came in weaker than expected, about 17.5 thousand versus the expected of 22.5 thousand. And last month was 63,000, right? So you can see quite a dip in the jobs. And again, something that we were expecting, that jobs are going to start to see this decline, especially of all the rate hikes that have been done from the central banks around the world, right? So we're starting to see the data be impacted. Now, with this jobs report that came out on Friday at 8:30 a.m., you also got the average hourly earnings month over month coming weaker at 0.2% versus the expected of 0.3%. So basically showing a little bit of weakness in the wage component. Look at the unemployment rate also. It picked up a little bit by from 3.8% to 3.9%. Again, nothing big there, but you do see a slight spike. What will be very interesting if that number goes to 4%, 4.1, 4.5, because generally when that number does go up by a large amount, it basically signals to you that, hey, a recession is literally around the corner. Right? So this number is looking like it's ticking up slowly. I'm just going to quickly look at this number and see again. If I look at the over the 2 years, yeah, 3.9 basically takes us to almost close to January of last year, January 2022. Right? So we're creeping up. So if you see this unemployment rate number of this year, the lowest it was around 3.4. So 3.4 was also in the beginning of this year, around February, March, and then the number also showed 3.4% again in May. And since May, I mean, it's had its spikes, but it's got a clear trend from 3.4 to now 3.9. Can it come down next month? Sure. I mean, anything can happen in the data, right? But this number comes in higher than the previous numbers that reported last 2 months of 3.8%. So you're seeing unemployment rate also tick up, tick up, tick up. And again, it's slow. You're not going to get this happen right away. Eventually you will see it later on, but all the tightening that has been done, it's starting to creep into the economy. So it starts slow, and then boom, you get a spike, and then everyone's shocked about, like, what happened? I thought the economy was fine. I thought there was no recession. I thought soft landing. I thought everything was good, right? So generally, that's how in history it plays out. So 3.9%, and we want to monitor if this goes to 4% above that, which is January levels of last year, and then 4.2, 4.6%. 4.6, we're talking about levels back in 2021, right? Because since COVID, things were the unemployment rate did spike, and then it was taking time for it to come down. So if that number starts to creep up, then definitely you could expect some sort of panic in the markets, right? So that's 4.6, and then the number could spike up if there's a credit event, right? So very interesting that the jobs report, the U.S. jobs report, came in weaker than expected. Unemployment rate up, less jobs, average hourly wages, the inflation, the salaries coming in weaker. So everything weak across the board. And what did stocks and bonds do? They went up. So you're probably wondering why. Why did stocks go up on a weak report? Why did bonds go up? Well, bonds tend to go up whenever there is risk in the economy, right? It's usually a safe haven play. So money flows into bonds, bringing the yields down. So, if you're trading around that time, the easy trade was to be buying bonds. Now, at the same time, stocks as well, right? Stocks went up because those long end yields were coming down. Bond prices were going up. Stocks were basically cheering that, hey, look, the data is weak. That means no more hikes, no more rate hikes, no way the Fed can hike further, right? Let's not forget we still got another jobs data in December before the Fed's meeting, and we got 2 inflation reports. One this month, one next month before the Fed's meeting. So, enough data to consider if we're going to get a rate hike or not. But, where the odds and probabilities lie is that it is less likely we're going to get a rate hike in December. So the markets were cheering today, just basically saying that, hey, we're not getting a rate hike. We're done. He's pausing. Powell's pausing. That means what comes next after a pause? A cut, a rate cut. Now, the thing is, right, all this cheering, you might hear on the news, on the headlines that, hey, look, stocks went up, markets are happy, soft landing, right? They might push out the narrative that things are actually looking better and fine, and this is the end of Powell raising rates. And there's no point of hiking further, so we are now out of the woods, right? Well, I don't agree completely with that statement, because if there's rate cuts, it would be because something bad is happening in the economy, like aka this report, right? This is just the beginning. It's not super horrendous report, but this is just the beginning. Wait till you start to see these numbers come in negative. The jobs number, right? Then you'll be like, whoa, what's going on here, right? And wait till you see that unemployment rate spikes up. And on top of that, even the ISM manufacturing number, which also came out today too. And that number came out, I believe, if I just check here real quick, it is, now the prices component came in a little higher, 58 versus 56. That was completely shrugged off. Employment component came in at 50 versus the expected of 53. And the headline number came in at 51.8 versus the expected 53. So any number above 50 is generally expansionary. Any number below 50 is contractionary. But this number came in lower than the expected, signaling weakness in the non-manufacturing industry, in the services industry, right? So you're seeing that the growth, the demand is getting weaker and weaker, and hence bonds and stocks gave more fuel for bonds and stocks to continue to go up higher and higher, and just because of no rate hikes. Now here's the thing, right? This data right now, today, as of right now, is giving the fuel for equities, giving the fuel for bonds, giving the fuel for markets to go up higher. You're going to hear that, hey, again, from the media, from everyone saying that, we're out of the woods. But here's the thing. The equity markets, if you look at it often, tends to take things a little too far and get carried away, right? And there will be a point where today, right now, bad data is good. It is being considered good for stocks. But there will be a point where bad data is not good anymore. Bad data is bad, right? And you would think, if you're, very new to trading, you would think that bad data is bad, so short stocks, sell stocks. Stocks should not be going up. But in this case, bad data is good and good data is bad for stocks. But I believe this narrative is going to change quite soon. That bad data is eventually going to be considered bad for stocks because it's going to signal there's something deeper, bigger, a bigger problem, beneath all of this data and this optimism that's not being really priced in from the equity markets. Now, bonds can rally all day long on basically safe haven flows, right? On risk off flows. But equities eventually, I think, are going to diverge and eventually start to panic because as they see the data and start to realize that, oh shoot, all the tightening that the Fed has done, I think we're going to see something pretty bad in the economy show up soon, and that's where you might see the selling come in, especially with when you look at the commitment of traders report. Not many people are short anymore, right? Very few or none. And you see that also plays into the markets, where that, hey, most people are either not short or they're long, and then if there's any panic, then people panic to get out of a trade rather than to get in a trade. So you generally tend to see that in the markets, and that panic will happen for people who bought and need to cut their losses quickly, and that causes a trickle effect which may cause equities to really, really drop further. Again, it will all have to do with this event, with the credit event, with the weakness in the data. So as of right now, it's going up on this optimism of no rate hikes, but eventually I believe that will turn around, and then you'll get pessimism, and you're going to get the markets to start to fear all over again that, hey, the recession's around the corner and this might be a bad one. And I don't think that's priced in the markets well enough. And then that is what will create the panic effect. Now let me play a little bit of devil's advocate here. What if you're wrong, Daniel? Right? What if it is a soft landing? What if we don't get that hard landing? Then what happens to equities? Well, if the data continues to be weak, or not so weak but not so weak, then sure, you could get equities continuing to rally if they get inflation, coming down lower, maybe to the close to the 2%, but not there yet. Then sure, maybe stocks will like that. But it's all going to be dependent on that inflation number, I would say, because if there's no hard landing, then I would say that's a mistake. Then what we are witnessing right now, a policy mistake from the Federal Reserve. That this is a policy mistake. The fact that you're pausing right now means that you haven't done enough. You're not doing enough. That means you should raise rates further. Because if from a year from now or so, nothing's breaking, and inflation is not really at 2%, but the economy is still fine, and you pause rates, then it comes back to the same scenario when Fed back 2 years back, 3 years back, was basically saying, that inflation was transitory. 1-2 years back, Fed was coming out and saying inflation is transitory. This inflation you're seeing is going to subside, and they were wrong. They were wrong about that, and they were too late. And if they do that again, they're too late, or they're wrong again, that's going to look really, really bad for the Fed. So, could this would be insane. Could Powell pull off an Arthur Burns where, he starts to think that's time to cut rates into, let's say, next year, starts cutting rates, nothing bad happens, inflation reignites, maybe Powell cuts rates into as we approach the election years. Could be political, right? There's a lot of things that could happen. And still, we haven't seen the inflation levels come down. You're basically pulling an Arthur Burns, and you made a policy error, a policy mistake. And then that means the next round of trying, maybe after, let's say, elections, if inflation's not come down well enough, then you're going from rate cuts to back to doing another round of rate hikes, which might be more aggressive than 2022. So imagine this to play out, right? I'm not saying it's going to happen, right? I'm just answering, let's say, the hypothetical question that, what if there is no hard landing and the Fed starts to soften, because they're softening right now, right? So if they start to soften and there's no hard landing, and even if he starts to cut rates, then this pause, right? Even if they don't cut rates, even if they just keep it as a pause and things are still doing well, then this pause is a policy mistake, which means that if they pause, let's say all of 2024, and inflation is not down, then 2025, there's no credit event, nothing, then that means you're going to have to hike again further, and you might have to do more than 2022 just to bring inflation down, and especially if inflation's reignited again, right? So that's the risk, I would say, from not solving this right now. So what Powell needs to do to bring inflation down, to slay this dragon, is to be aggressive. And he's not really doing that, which is very interesting, right? He was doing that in 2022, but we see how long and extended, right, this economy's been going on without any hard landing. Everyone's been saying a recession is coming, and it's not there, right? So you see how extended it is because also there's a lot of contribution from the fiscal side of things, all that spending of money that is also propping up and keeping the markets and the economy in a better shape. Although, yes, after today's report, you are seeing some weakness, and it'll be very interesting to see, does this weakness continue its trend? If Powell's really slayed the dragon of inflation, you would want to see very, very weak data, unemployment rate skyrocketing. That's how you solve inflation. As sad as that sounds, that's how you bring inflation down, according to history, is you create a recession, a hard landing, and you make people lose jobs, right? And that's what's going to cause prices to come down and then rebalance, reordering into the economy. And then depending how bad this recession is, then you're going to get the Fed to come back and re-stimulate and cut rates and etc., etc. So those are just my 2 cents on how I think things are playing out. Another thing I want to mention, we also saw, let me just 1 second. So also there was a report, a news article that came out today on Maersk cutting 10,000 jobs as shipping demand drops. So I'll leave this link in the description so you can read up on it. But this basically says that one of the world's largest shipping companies, Maersk, is cutting 10,000 jobs because of a drop in demand triggered by global economic slowdown. The Danish company said it had already started cutting staff, but it was planning to intensify cost-saving measures in order to safeguard its financial performance as price forecasts worsened. All right, price forecasts worsened, cutting costs. Biggest shipping company out there, shipping, transportation is the bloodline of the economy. And you're seeing Maersk, one of the biggest shipping companies, tell you that demand is dropping. We are laying off workers, right? Maersk already, revealed on Friday that it had axed 6,500 jobs this year, taking its headcount from 110,000 in early 2023 to 103,500 today. It said it would increase those efforts, cutting another 2,500 jobs in the coming months and a further 1,000 in 2024 in order to cushion the impact of challenging market conditions. Right? Overall, Maersk said to shrink its global workforce by 10%, fewer than 100,000 positions. So you can go more further into this article, but right here, is telling you the weakness, the signs are showing up. We got the jobs data today from the US, Canada, and now Maersk talking about they're slashing jobs. And it's happening slowly. The key thing is slowly, right? America's not going to come out all of a sudden and just axe everything because they think that something is going to come in the future. A lot of companies do it a little bit delayed because what if they're wrong, right? What if there's no hard landing? Then you got to rehire and it's going to bring in more cost for you. So you're seeing that demand drop, you're seeing the pain, and you're seeing that slowly and slowly as more data and reports come out that jobs are being lost, demand is dropping. That's going to feed into that inflation metric and feed into the goal of all the central banks around the world, what they have been doing all this time, hiking rates to control the demand side, the demand curve. They can't control the supply curve, but they can control the demand curve and create demand pain, create job losses, stop in spending, affect the consumers. Because let's not forget, GDP, consumer spending is a big portion of GDP, right? So if we start to see consumer spending really, really drop, a lot of the companies will feel the same thing and feel the pressure to not only cut costs, but also eventually, mark my words, to cut price, right? Nobody's buying from you. There's low demand. It's very weak. What are you going to do? Keep your items, keep your goods on your shelves for too long? What if, there's an expiry date on some of them? What if you need to get rid of it because it's a cost for you to keep it on your shelves? What are you going to do as an entrepreneur, as a business owner? You're going to cut the price, get it off your shelves, right? Let's not forget also during COVID time when things were stuck, supply chain is stuck, still stuck today too, right? You got a lot of people, a lot of companies that went out, ordered a bunch of goods, and then realized once those goods came in that the demand was not the same like it was during COVID. Right? So again, you got a lot of these items. Just look around in your store. Halloween time. How early it was that a lot of companies out there, retailers, were pushing out the Halloween gear because they wanted it off their shelves. Same thing. Christmas, right? Right away, Halloween's done. Okay, sell the Christmas stuffs. Come on, we need these things off our shelves. Let's go. This is a cost, right? But lo and behold, while this is happening, you also have the demand crunch. And everyone's feeling the pain, and especially the consumers. And the job of the central banks is try to engineer and slay this inflation by creating the pain throughout the whole economy, through the corporations, the employees, all of these people, right? That's what they're trying to do here. So anyways, check out the article. I'll leave it in the description. Let me know what you guys think. Leave a comment below, and subscribe, hit the like button and bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.